This is the Value Investor Podcast with Tracey Reineck. All things value, all the time.
Welcome back, value investors. So the stock market continues to hit new all-time highs nearly every day, but this is making some value investors very nervous, as I know it's probably making some of you. But even some big-name value investors are starting to speak out about value versus growth. And one of those is hedge fund manager David Einhorn of Greenlight Capital. And you may be familiar with his name because he's a pretty big, well-known investor who invests billions of dollars, basically. Greenlight Capital is billions. And he recently sent a letter to investors, which these hedge fund managers tend to do at least once a year, but some of them send them every quarter, I believe. And he complained that it's just too hard being a value investor right now. So you might have heard about this. So I'm going to read some of what the media is saying the letter said. And here's one of the quotes. So he said, "The market remains very challenging for value investing strategies, as growth stocks have continued to outperform value stocks. The persistence of this dynamic leads to questions regarding whether value investing is a viable strategy." So AKA, is value investing dead? Sounds like he's starting to question it here. But remember, he's not only a long-only investor. He also invests in undervalued and overvalued companies. So he's basically shorting some of the overvalued names. And specifically, those mean, for him, Amazon and Tesla. So he complains that value investing isn't working, and he's not sure when it will do so again. And a lot of it has to do with these bets against the big growth names. So he also says this quote, which I'll read out: "The knee-jerk instinct is to respond that when a proven strategy is so exceedingly out of favor that its viability is questioned, the cycle must be about to turn around. Unfortunately, we lack such clarity. After years of running into the wind, we are left with no sense stronger than," quote, "it will turn when it turns," unquote. So he's basically saying he's been a value investor all this time. Growth is dominating over value. He's been trying to short companies like Amazon and Tesla, who he believes are overvalued, and he's getting burned pretty badly in basically all of these investments. So Greenlight Capital saw a return in the third quarter of 6.2%, which isn't too bad, but its year-to-date performance is still up just 3.3%. For comparison purposes, the S&P 500, if you just put your money in that, not given your money to him at Greenlight Capital, you'd be up 14.2. So you can see it's pretty big underperformance, which is why he's complaining and basically saying it might be different this time. You can't bet against these big growth names because that's not working. And the market's willing to pay whatever it takes for some of those big growth names. Now, this kind of goes back to what I was talking about last podcast about the Nifty 50, right? It sounds very similar, but we have been seeing this outperformance. And I went and checked again just to see, because I haven't talked about it in a couple months, how good growth is doing versus how bad value is doing. So I looked at the iShares Russell 2000 ETFs, and the value is IWN there, and the growth ETF is IWO. These are the small caps again, and growth is up 17% year to date, that growth Russell ETF, and the value is up just 4.8. So you can see huge difference there, and value investors are really feeling it if they've only been value investors. Then I took a look at over 5 years, and the growth is up 96%. The value is up 71%. So this is what David Einhorn's complaining about, that even over the last couple of years, he's really been in the doghouse there with the value stocks. So it looks pretty bad. It looks like it's supporting what he's saying, that value investing just isn't viable right now. And basically value investing is dead. But it's kind of inaccurate to say that there's no value stocks, because remember, he's taking a two-pronged strategy. He's betting against these overvalued growth stocks and he's buying value stocks. But growth stocks could have a run like this for many more years. As we've seen, as I talked about with the Nifty 50, they certainly did in the late 1960s. It went on for years with those valuations rising before it finally started to correct. And even in the late 1960s, Warren Buffett even threw in the towel on what was going on because there were simply almost no value stocks, which is what he said. He said he can't find anything to invest in, and I'm returning my money to you, to all your investors. So people forget that there have been these periods when growth is just really dominated, but eventually the value does come back. Also, we saw this in the late 1990s, where if you weren't in one of the hot tech titan stocks like the Cisco or Intel, then you were being called stupid, dumb, idiotic. And remember, Buffett again was mocked by growth investors during that time because he didn't own a single one of those hot tech stocks. And they kept claiming, oh, he's missing out on the internet revolution. Well, eventually that burned itself out too. So again, Einhorn is complaining about his shorts on these overvalued growth names like Tesla and Amazon. And maybe he's just too early because a lot of times people get in on a trade and discover that it kind of runs away from them. So even in 1996, remember, Alan Greenspan, the Fed chairman, called out the irrational exuberance of the stock market, but it lasted 4 more years, that exuberance. And then even in the recent decade, in 2006, 2007, there were traders, the guys from The Big Short movie and the books, they were betting against the mortgages, remember, the mortgage-backed securities, and that those would blow up. And they had never been more sure of their analysis. And it turns out they were right, but they also had to wait quite a long period of time, so long that a couple of them were having anxiety attacks. They were, basically put, in the corner, basically by their own investors. They too were told, you're wrong, you're dumb, all of that stuff. And they almost didn't make it through that trade, but eventually they were vindicated, obviously, and they were right on that trade. But this is what happens in bull markets. Judging the end where the bubble happens is really difficult. And they always go on far longer than you think. You can say the same thing about the housing market too. A lot of us were bears as early as like 2003, saying that these gains in the national housing market could not continue. And they did for basically another 5 years. And even when it started to blow up, people didn't want to believe, no, it's not over, you're wrong, for people who said that, the bubble was ending. So it's really hard to keep your own strategy when it's in the outs, basically. And so you're seeing this now with David Einhorn in this letter as he tries to explain his returns to his investors that, you start to come to this conclusion, maybe this isn't viable after all, and I can't remain a value investor. But we know value investing isn't dead. Maybe betting against these overvalued companies is not a good strategy, but value is still out there. And I've talked about many of them over the course of even just this year. And one of those was Micron, which is ticker MU. We've had it on this podcast several times because it's so cheap. And really, it's been a value all year long. It's up 84% year to date, but you could have bought it just a couple months ago and still be up, 30, 40%. And it was still cheap a couple months ago. It's still trading with single digit PEs right now. As long as those earnings keep rising, that's an issue with Micron because it moves in cycles, this kind of company and business, but they said that it's still looking good for 2018. So that's why it's so cheap. So Micron up 84% year to date, while Amazon is up only 29%. Those poor Amazon investors. Oh, too bad for them. Only 29. So there are values, and some of them are performing better than maybe the overall value index is. So I ran a screen looking for other just classic value stocks, and these would have a rank of number 1 or 2. I kept the really good rank, so I get the rising earning estimates. And the classic values, if you remember from some of our other podcasts, are price to earnings. I use the PEG, I use price to book, and I use price to sales. So the price to earnings I kept under 20 because it is hard to find anything, really, really cheap with all these other valuations in there that are also cheap. So the PEG I put under 1, The price to book I kept under 2 instead of my usual 3. So that's pretty narrow. And the price to sales I kept under 1 as well. So this is a very narrow screen. I was even thinking when I ran this, geez, I might only get, 1 or 2 stocks, maybe nothing, because this is like the best of the value stocks here. Rising earning estimates and all of these fundamentals that are really cheap, and it has growth because we got that peg in there. And I got 10 stocks, so that was more than I thought. And some of them are what we've talked about before, but I'm going to give you 3 here. So these are the classic values that are kind of out there right now. A couple of them haven't reported yet. So warning, like they haven't reported, so we're not sure yet what's going to come down the pike here. But these are ones to keep on your list if you are still looking for value stocks. And David Einhorn should keep these on his list too. So the first one is one we've definitely talked about before. I own this in the value investor portfolio, and it's KB Home. I like a lot of these home builders. Most of them are cheap right now. So this one just happens to have all these classic value fundamentals, but some of the others are also showing up in the screens. KB Home has already reported. It was a great quarter. So it has a PE of 15.3. So a little bit higher than my usual 15 and under, but still very attractive. And then it has the PEG of 0.8. Gotta love that. Price to book is just 1.3, and the price to sales is 0.6. So all these factors are great for value. And the stock has been on the move. It has a lot of momentum right now. As the economy stays hot, people want to be buying new homes, and that market has been real strong. So our second company is Magna International. MGA is the ticker. I used to have this one in the Value Investor, but when the peak auto worries happened, we sold out of it. It's been cheap for several years, really, because people are worried about the peak auto. So they've been avoiding these auto stocks, but they do auto parts. They're based in Canada, and they're one of the largest North American auto parts suppliers. They supply to all the auto companies, doesn't matter where they are, it's, worldwide. So they have their hands in all the markets. They're still dirt cheap. They have a PE of just 9.3, so it's under 10 PE, rarely see that. They've got a PEG of 0.9. The price to book is 1.9, and then the price to sales is 0.5. They're a large cap, 20 billion market cap, so this is not a small company, and they've been rewarding shareholders basically for their patience while the peak auto trade is kind of playing out, and they pay a dividend of 2% yield on that dividend. So they haven't reported yet. They're going to go in November. This is one that's cheap. If you're interested in that auto play, we just had some good numbers out of General Motors. This is one to keep on your list. And then the third stock is in the dreaded retail sector. Yes, I know. Everybody hates it, but that's why it's value, and it's called Boot Barn. You might not be familiar unless you bought some boots. The ticker is BOOT, BOOT. This is a small cap, so it's going to be volatile. It's just 226 million market cap. It also trades under $10, which I know a lot of you like because you considered it a cheap stock by that factor, but it's also cheap by its valuations. So it has a PE of 14.3. Its PEG is just 0.9. It has a price to book of 1.2, and its price to sales is 0.3. But these retail stocks have really gone down, and a lot of them have interesting stories. They have 219 stores in 31 states, and they also sell online. But they specialize in like Western boots. You find them a lot in, the southern states and California. And this is a real popular product, but apparently investors believe it could be Amazoned, even though they are seeing some rising earnings estimates here because they got the good rank. But they haven't reported yet either. I couldn't really tell. They haven't announced for sure when this conference call is going to be. It might be next week, the first week of November, or it's going to be early November at some point. So this is one to keep a watch on. You might want to wait until they report and kind of see what they say. But retail isn't totally dead yet. It's kind of like value investing. Everybody thinks, oh, that's over, but we're all going to be shopping. And people want to go into the stores to buy their boots, apparently. So this is one to keep watching. So those are 3 stocks right there that I found doing this super narrow screen of classic value. I've expanded those screens throughout this year, almost every week to get more stocks. But for anyone to say that value is not in this market is just not really correct. You do have to dig around. You do have to go into areas that aren't the glamour areas, places that are out of favor, like the retailers, even the peak auto. A home builder's not really out of favor, but nobody's paying attention to them. You might have to go into the banks. That's a cheap sector right now. I've talked about the banks in the past. And you might have to go into energy. Oh, no, not that, not energy. Everybody is negative on a lot of these sectors, but that is where the value is. So when is it going to turn around? I don't know. When is value going to suddenly take the lead, which it historically has done? I don't know. But I'm finding the value stocks. You can too. And my advice would be don't bet against the growth stocks. Don't do what David Einhorn did and then get upset when it's not working. It doesn't have to be either or. You don't have to be like, I must own all value and no growth. I own some growth stocks, which I've said. I own Amazon, for instance. So own some of both, have a diverse portfolio, and then you're playing it either way. So remember those tickers. Let me run through them again. Well, we had Micron, which we've talked about in the past. That's ticker MU. And then we had the KB Home, KBH, Magna, which is MGA, and then Boot Barn, which is BOOT. And if you're interested in listening to the Nifty 50 podcast, be sure to check it out on SoundCloud. You can find it over there under Zach's Market Edge. And you can also get everything on iTunes. Be sure to subscribe on iTunes. We have a standalone show on the Value Investor podcast on iTunes, or you can get both shows, the Zach's Market Edge and Value Investor, under the Market Edge name over on iTunes. And be sure to check out that Nifty 50 episode, because that kind of blends in with what is happening here this week with David Einhorn. And I'll be back again next week with some more value stocks.